Planned a video for you this morning. I made a thumbnail and everything, but halfway through I stopped myself. It's been almost a year to the day since I transferred my old company pensions into a self-invested pension, a SIP. I realised I was repeating the same mistake I've made constantly over the last 12 months. I was changing my strategy once again. So 11 months ago, I started this channel, and my hope was that I would get some good advice from others who were in a similar position to me, either retired or about to. And I wanted to learn more about how to invest my pensions. But at the start, I received some advice, and that was stick to 60% in the world index and 40% in safe bonds, and then leave the hell alone. I had a look today what would have happened if I'd done that, and I'd have had a 16% return. And if I'd just put the lot in a world index and left it alone, I'd have had a 23% return. But I did neither of these things. I changed my position constantly. In fact, I logged on to Free Trade this morning and I printed off a list of my trades, and I've made 206 trades in the last 365 days. And what was my return? 9.5%. Now, don't get me wrong, inflation for last year is 2.3%, and I made 9.5%. And if you'd asked me 12 months ago, I would have bitten your hand off for this. I'm not disappointed with returns. I'm disappointed by my own lack of discipline. So my New Year's resolution, with the new year being the start of my second year of pension investing, is to stop fiddling with my portfolio and try to keep it simple. So where am I now? Well, I'm heavily invested in the FTSE 250, too heavily invested to be honest. So I need to back some of that out and get some funds into bonds and to get some into the world index as well. But then I want to choose one more fund with a slightly higher risk profile, and then I want to leave the hell alone. So this takes me back to the start of the video and this thumbnail. An index fund I am considering after reading a few articles about American small cap investing is the Russell 2000. Now, the FTSE 250 index I hold weighs me far too far away from the American market, and I wouldn't be able to sleep at night if I was too heavily invested in US big tech, particularly Tesla and Nvidia, which I hold some deeply entrenched doubts about. Therefore, the Russell 2000 is appealing to me. You know, I'm a sucker for articles and adverts. I can't eat ready break in the morning without imagining myself with an orange glow. And that advert hasn't been on since the 80s. According to Tom Lee from Fundstrat, the Russell 2000, which is made up of small cap stocks, in the coming years is expected to perform 100% better than the S&P 500, which consists of large cap stocks. He says this is because small cap stocks tend to see greater advantages from decreases in interest rates and are currently trading at lower prices. While the Vanguard Russell ETF offers exposure to small cap stocks, it has a lesser focus on tech stocks, well, compared to the S&P 500. In general, the S&P 500 is the preferred stock market barometer for large cap companies, while the Russell 2000 is preferred stock market barometer for small cap companies. The S&P 500 median market value per company is around 37 billion, whereas in contrast, the Russell 2000 index consists of nearly 2,000 companies, averaging approximately only 1 billion. Should his prediction prove accurate, the Russell 2000 would run circles around the S&P 500 in the next few years, and perhaps even double its return, Lee suggests anyway. The Russell 2000 is benefiting from two favourable factors. So according to Tom Lee, small cap stocks may outperform in the near future for two reasons. Firstly, the Federal Reserve has recently begun reducing interest rates, which tends to benefit smaller companies. And this is due to their higher proportion of variable rate debt. Additionally, small cap stocks currently have lower valuations compared to the large cap stocks. And you know, this viewpoint is not exclusive to Lee. as other Wall Street analyst experts such as JP Morgan Chase strategist Michael Semblest has also highlighted these points. In July, Semblest stated that small cap stocks are currently at their cheapest levels since the start of the 21st century and have the potential for growth due to market political catalysts. And these catalysts include declining interest rates and potentially tariffs proposed by Donald Trump as well. Also, in a recent blog called Time to Shine, Goldman Sachs strategist Hanya Schmidt and Jen Nusser discussed the impact of interest rate cuts on small cap valuations, and their points were: historically, the Russell 2000 has performed better than the S&P 500 by an average of 12 percentage points in the year following the end of a rate cutting cycle. And since 1985, the PE ratio of the median Russell 2000 stock has been on average 2% lower than that of the median S&P 500 stock. However, this difference is currently at 28%. Now, it's important to note that the current rate cutting cycle actually began in September of this year and is expected to continue for several months. Therefore, the point will only become relevant once this cycle ends. Currently, the relative valuation of the Russell 2000 compared to the S&P 500 is 26 percentage points lower than its average over the last 4 decades. Now, the Vanguard Russell 2000 ETF includes value stocks and growth stocks from all 11 market sectors, though it's most heavily weighted towards industrial, financial and the healthcare sectors. But most importantly, the Russell 2000 offers much less exposure to tech stocks, much less than the S&P 500. So specifically, the Russell has 11% of its market value in tech stocks, while the S&P 500 has 32% of its market value in tech stocks. And this discrepancy is noteworthy because the tech sector was the best performing market sector over the last 5, 10 and 20 years. So consequently, the Vanguard Russell 2000 ETF underperformed the S&P 500 during these periods. In fact, while the Vanguard Russell 2000 ETF advanced about 125% over the last decade, the S&P 500 surged about 245%, essentially doubling the return of the small cap benchmark. Now, an important caveat is the expense ratio. The Vanguard Russell 2000 ETF carries an expense ratio of 0.1%, meaning that if you invest £1,000, you'll pay £1 annually. And comparatively, the Vanguard S&P 500 has a much lower expense ratio of 0.03%. So here's the bottom line. Fundstrat's analyst Tom Lee thinks interest rate cuts and historically cheap valuations will help the small cap Russell 2000 outperform the large cap S&P 500 by over 100% in the next few years. I'm dubious. The S&P 500 has crushed the Russell 2000 in recent history because bigger exposure to the tech sector, really. And this trend could continue into the future as artificial intelligence boom unfolds. Who knows? I'm no expert, I'm no financial advisor, so don't take any of this as advice. For my portfolio, I'm just simplifying. I'll let you know how I'll get on.
I didn't take your advice at the start of year 1. What should I do for my second year? Leave it in the comments. See you on the next one.